Welcome to the deep dive. We're here to sift through that mountain of information, all the articles, the research, our notes, and really pull out the key insights for you. Our goal today is simple: cut through the noise, give you the well-informed shortcut to understanding the market. Specifically, what went down last week and what's potentially coming up. Think of this as your essential weekend deep dive. We're going to analyze the market's moves from the week of August 11th through 15th, 2025. It was, well, quite a week. Remarkable highs, but also some really conflicting economic signals. And then, of course, we'll look ahead to the coming week, August 18th to 22nd, highlighting the really critical events that could steer things.
Yeah, it's fascinating, isn't it? That tension was just palpable last week. You had this strong investor optimism. I mean, it pushed major indices to new all-time highs. But it ran smack into this macroeconomic backdrop that was hinting at a much, much tougher road ahead. It's not just about the numbers themselves.
Yeah.
It's about reading between the lines, interpreting these signals that seem to contradict each other, and figuring out what that means for policy, for market direction,
Yeah.
especially as we close out one week and gear up for the next.
Yeah.
Kind of like the market was celebrating on a tightrope, right? While the economic data was shouting warnings from below.
The week that was August 11-15, 2025. 1.1 executive summary. The inflation conundrum at all-time highs.
Okay, right. Let's unpack that. Because the core story last week really was this tension. You had, like you said, bullish momentum, S&P 500, NASDAQ Composite hitting new all-time highs. Amazing stuff.
Yeah.
But then the macro picture just seemed to be pulling the other way entirely. It really kicked off with this wave of optimism, didn't it? Fueled by that July Consumer Price Index, the CPI report. It seemed pretty benign at first glance. And that really lit a fire under the early week rally, sparking all those hopes
Yeah.
for a September Fed rate cut.
Yeah, it felt like the market got the signal it wanted.
Exactly. Like, okay, here we go. Easing is coming after months of just waiting and wondering.
And that's precisely where things got tricky, because that optimism, it got seriously challenged, maybe even undermined just a couple of days later by that Producer Price Index report, the PPI. And this wasn't a small miss. It was unexpectedly hot. It painted a very different inflation picture compared to the CPI.
Right. Completely different vibe.
And if you connect that to the bigger picture, this sharp divergence in the inflation signals, it brings up that uncomfortable idea of stagflation light.
Ugh, not that term again.
I know, nobody likes it, but it's a really tough spot for policymakers, particularly the Fed, a real challenge, because you've got signs of slowing economic growth. We'll get into the evidence for that, combined with these persistent inflation pressures coming through the production pipeline.
So what are their options then? It sounds like a lose-lose.
Well, that's the dilemma, isn't it? If they hike rates to fight that sticky inflation, they risk slamming the brakes on an already slowing economy, maybe tipping it into recession. But if they cut rates to try and support growth, they risk letting inflation get even more entrenched. Their usual tools just aren't as effective when you've got both problems at once.
Yeah, walking that tightrope, like you said.
Exactly. Puts them in a very difficult position.
Okay, so the markets did technically manage a second straight week of gains. But you could almost feel the fatigue setting in, couldn't you? Especially in tech.
Definitely.
Tech's been the leader all year, really pulling the weight. So seeing weakness there makes you wonder, doesn't it? Was that rally really broad, or was it kind of masking some underlying weakness?
Yeah.
Just propped up by that one hope.
That's the key question.
Because the main driver for those highs, the expectation of the Fed easing up soon that's now directly challenged by this latest inflation data. That foundation suddenly looks a bit shaky.
It's a critical point, and it directly impacts your outlook as an investor. The market seems largely priced for that perfect scenario, the soft landing.
Right, where inflation cools down nicely without causing a big recession.
Exactly. But the incoming data, especially that hot PTI, it just doesn't fully back up that rosy picture anymore. And that creates a significant vulnerability, a real risk of what we call a hawkish repricing event from the Fed.
Okay, break that down. What does hawkish repricing mean for, the average person's portfolio?
It means if the Fed signals they're going to be tougher on inflation than the market currently expects, maybe saying rates stay higher for longer, maybe taking that September cut off the table entirely, then assets that have benefited from low rate expectations, like a lot of growth stocks, could see a really sharp, sudden drop. Investors would have to quickly readjust their expectations about future profits, borrowing costs, everything.
Ouch.
So, as the week wrapped up, naturally, all eyes turned towards Jackson Hole, that upcoming economic policy symposium, Everyone's waiting for cues from Fed officials on how they're reading this incredibly mixed, contradictory economic picture.
Yeah, that's going to be huge for setting the tone right.
Yeah.
Could really show which way that tightrope walker is leaning. 1.2 weekly market performance. A tale of two halves.
So, bringing it back to the charts, what did this actually mean for returns last week? We got that second week of gains for U.S. equities, sure, but like you said, it wasn't smooth sailing. Definitely volatile, big swings within the days, between the days.
Yeah, real tug of war playing out.
The week started off really strong. Powerful rally Monday, Tuesday, lots of dip buying, general optimism before the data hit. That pushed the major indices up to record levels by midweek. But then the momentum just sort of fizzled out in the second half, didn't it? Especially after those conflicting economic reports landed.
It did.
And that led to that mixed, slightly down session on Friday, which finally broke the S&P 500's record close streak. But what's really interesting, I think, is looking beneath the surface of those headline numbers. We saw this subtle but potentially significant rotational shift.
Oh, yeah. What kind of shift?
Small cap stocks, the Russell 2000 index, they were the real standouts. They significantly outperformed the large caps.
Interesting. So not just the big tech names.
Exactly. It suggests maybe, just maybe, a tentative broadening of risk appetite beyond those mega caps that have dominated for so long.
And why does that matter? What's the signal there?
Well, strong performance in smaller, more domestically focused companies. It's often read as a sign that investors see easier financial conditions coming. That would typically benefit these more economically sensitive firms, the ones that rely more on domestic growth and easier borrowing.
Gotcha. So a little bit of hope maybe hidden in the numbers?
Could be. It's a quiet signal, but potentially an important one amidst all the noise.
Okay, let's run through those index numbers for you because they do tell that story of shifting dynamics last week. The Dow Jones Industrial Average actually led the large caps. It got a big boost from that healthcare rally late in the week. We'll definitely circle back to that.
Right.
It even briefly hit its first intraday all-time high of the year on Friday. So for the week, the Dow finished up a solid 1.74%. Year-to-date, it's now up 5.65%.
Pretty strong for the Dow.
Yeah. Then the S&P 500 set new records, then pulled back. Ended the week up 0.94%, putting it at 9.66% year-to-date. The NASDAQ Composite, same story, new records early on, finished up 0.81% for the week. It's still the year-to-date leader, though, up 11.97%.
Still strong, but maybe less dominant last week.
Exactly. And then the Russell 2000, the small caps you mentioned, that strong performance showed that renewed interest, up an impressive 3.07% for the week. Its year-to-date number is still lagging a bit at 2.53%, but a big move last week.
Definitely suggests that rotation might be happening.
So yeah, all major indices up, but the leadership is clearly starting to shift around. Now let's dig into that day-by-day story, because the price action was really a mirror of those shifting macro interpretations in some key company news. A real battle playing out. Monday and Tuesday started with a bang. Major averages had their best daily gain since May on Monday. Just significant dip buying, showing real conviction.
Investors were eager to jump back in.
Totally. And that momentum just accelerated Tuesday after that July CPI report, those inline inflation numbers. The market read them as a clear green light for a September Fed cut. Just pure optimism.
They're ready to believe it.
Oh, yeah. S&P 500 hit its first record close since late July. NASDAQ, its third in 4 days. It really felt like almost a celebration early in the week, traders betting big on the Fed loosening the reins.
Right. But then Wednesday and Thursday, things sort of plateaued. Equities mostly consolidated near those new highs. We did get some positive news, like that report about a mega-cap tech company investing another $500 billion in U.S. manufacturing.
That helped keep spirits up.
Yeah, a good signal of corporate confidence. But the market's underlying strength really got tested on Thursday with that much hotter than expected PPI report. That was the turning point, wasn't it?
It should have been. You'd think, a clear warning sign on inflation.
Right. Despite the initial downward pressure from that report, that buy the dip mentality just took over again. It really showed the strength of that bullish sentiment, that conviction in the Fed easing narrative.
Almost stubbornly so.
You could say that. So much so that the S&P 500 still managed to squeak out another record close on Thursday, seemingly just shrugging off that stark inflation warning. It was quite a display of market conviction. Or maybe denial.
Maybe a bit of both. Then came Friday, and the mood definitely shifted. A clear risk-off tone set in. That disappointing forward outlook from Applied Materials, the semiconductor equipment giant. It sent immediate shockwaves through tech, really weighing down the NASDAQ. A sudden reversal from the tech enthusiasm earlier.
Big contrast.
Huge contrast. But in the very same session, You had that massive surge in United Health Group, driven by the Berkshire Hathaway news, Warren Buffett stepping in.
The Buffett bounce.
Exactly. And that powerfully lifted the Dow Jones, allowing it to actually close up on the day and significantly outperform everything else, almost like it was trading in a different universe than tech.
Incredible divergence.
Right. And that session finally snapped the S&P 500's three-day record streak. It really highlighted the market's growing sensitivity to these sector-specific issues. Not everything was moving together anymore. That tightrope walk got a lot narrower. 1.3, the macro narrative, an economy at a crossroads. Hey, here's where it gets really interesting for me, because the economic data last week, it was just messy, contradictory even.
Yeah, a real puzzle.
You had consumer inflation looking contained, but producer prices surging. Consumer sentiment takes a nosedive, but retail spending holds firm. It's like trying to read tea leaves from 5 different cups at once. How do policymakers, how do you, as an investor, make sense of that?
That is the million-dollar question, isn't it? How do you reconcile these things that seem to point in opposite directions? The most critical piece was definitely those conflicting signals from the two main inflation gauges, CPI and PPI. They really get to the heart of the Fed's challenge right now.
Let's break those down, the inflation divergence.
Okay, so the Consumer Price Index, CPI, for July came out Tuesday. Headline inflation rose 0.2% month over month, 2.7% year over year. Pretty much bang on expectations.
So no big surprises there.
Nope. And core CPI, that's excluding food and energy, giving a clearer underlying trend, also met expectations. Up 0.3% month over month, 3.0% year over year. The main driver was shelter costs, up 0.2%. That's always a big factor because it's weighted so heavily. One interesting detail, though. Airfares jumped 4% month over month, breaking a 4-month losing streak. Gave airline stocks a bit of a lift.
Okay.
But the market's main reaction? Relief. Pure relief. It didn't suggest inflation was suddenly accelerating in a way that would stop the Fed from cutting rates. For a moment, it felt like, okay, the disinflation trend is intact, path clear for easing.
Yeah, the collective sigh of relief. But then came Thursday.
Right. Then came Thursday's Producer Price Index, PPI, report for July, and it landed like a ton of bricks. A huge, unexpected surge in wholesale inflation.
How big are we talking?
The headline index jumped 0.9% month over month. The consensus forecast was only 0.2%. This was the biggest monthly jump since June 2022.
Wow. Okay, that's significant.
Very significant. Annually, PPI accelerated to 3.3%. And core PPI, stripping out the volatile stuff, also jumped a startling 0.9% month over month.
So why is PPI so important here? It's not what consumers pay directly, right?
Exactly. It's what businesses pay for their inputs, materials, components, services. A big jump here is like a pressure cooker building steam in the supply chain. It's tangible evidence that things like President Trump's tariffs, which act like a tax on imports and other supply-side issues, are really driving up costs for producers.
Okay, so those costs are building up.
Right. And the worry is that this wave of cost pressure, if businesses can't absorb it all in their margins, will eventually get passed on to consumers, which directly challenges that nice, calm CPI reading we saw just 2 days earlier. It's a major warning sign that inflation might be stickier, more persistent than hoped.
A real fly in the ointment for the soft landing narrative.
You got it. Now, let's look at the consumer, the main engine of the U.S. economy. The data here was just as mixed, showing the strange split between what people are doing and how they're feeling.
Okay, so what were they doing?
They were spending. Retail sales for July, out Friday, showed a solid 0.5% increase, right in line with expectations. It shows consumer spending is holding up surprisingly well despite higher interest rates and inflation.
That's good news, right? People still opening their wallets.
Definitely a positive signal. And the control group number, which is the part that feeds directly into GDP calculations, also rose 0.5%. That suggests near-term recession risks are pretty low as long as spending stays firm. So the hard data on actions looked strong.
But how are they feeling? You said that was different.
Radically different. The preliminary August reading of the University of Michigan Consumer Sentiment Index. It was a big downside surprise. Dropped unexpectedly to 58.6 from 61.7 in July. Analysts expected 62.0.
Quite a mess.
Yeah. And this kind of sharp split between strong hard data like sales and weak soft data like sentiment can be a really critical warning sign, a leading indicator of a potential turning point.
Meaning?
Meaning, while consumers are acting strong right now, maybe running down savings or using credit, their confidence about the future is clearly shaky. They might be feeling the squeeze or worried about what's coming.
Okay, that makes sense. But what was the really alarming part?
The inflation expectations component within that survey, that's what really got the market's attention. One-year inflation expectations jumped sharply to 4.9% from 4.4%.
And the Fed watches that closely.
Very closely. Because if people expect higher inflation, it can become self-fulfilling. They demand higher wages, businesses raise prices anticipating higher costs. It makes inflation harder to control. So that 4.9% figure, it flies in the face of the calm CPI reading and totally amplifies the warning from the hot PPI. It suggests consumers are bracing for price hikes that might just force the Fed to be more hawkish than the market wants.
Wow, what a head-scratcher for the Fed, all these conflicting signals.
Exactly. And just briefly, other economic indicators last week. They kind of fit this narrative of a slowing but not collapsing economy. Weekly initial jobless claims stayed low at 224,000.
Still a healthy labor market then.
Seems so. Low claims mean businesses aren't laying off people in large numbers, which usually happens before a recession. And July's industrial production showed a small decline. Weak, maybe, but not weak enough to scream imminent recession.
So the picture remains complicated.
Very complicated. Some resilience, some slowdown, nothing definitive either way. Which is precisely why the Fed's job is so incredibly tough right now. 1.4 the Fed watch. All bets on Jackson Hole.
Right. Given all that ambiguity, all those conflicting signals, the Fed is in a really tight spot, isn't it? Trying to balance stable prices with maximum employment. And you saw that reflected directly in market expectations for rates there all over the place last week. Now, all the focus shifts to Jackson Hole. Feels like the entire market is just holding its breath.
It really does. And from a broader view, the market's, well, almost stubborn conviction in a September rate cut, even with all this conflicting data, it really highlights the challenge the Fed has in managing expectations right now.
How much did those odds swing around?
Wildly. The probability of a 25 basis point cut, that's 0.25% at the September FOMC meeting, it fluctuated dramatically. Hopes were already high after the prior week's softer jobs report. Then they shot up to near certainty after Tuesday's CPI.
People were really banking on it.
Oh, yeah. Some analysts even started predicting 3 cuts by the end of the year, which is pretty aggressive, suggesting a very quick Fed pivot.
But then the data turned.
Exactly. Those bets got scaled back quite a bit after the hot PPI on Thursday and the strong retail sales on Friday. Both argue against cutting rates right away.
Makes sense. So where did the market land by the end of the week? Still expecting a cut.
Remarkably, yes. It ended the week still pricing in about a 90% chance of a 25 basis point cut in September.
90%,
Yeah.
even after the PPI and retail sales.
90%. It shows this incredibly strong conviction that the Fed will prioritize supporting the cooling labor market over reacting immediately to those pipeline inflation pressures. It's almost like the market is telling the Fed what it wants, data be damned.
Wow. That conviction seems incredibly strong, and it really underscores that policy dilemma the Fed's in, doesn't it?
Absolutely.
The jobs report suggests the labor market is cooling, which supports a cut for the maximum employment goal. But the PPI surge, and maybe more importantly, those rising consumer inflation expectations, they scream inflation risk. That argues for holding rates steady, or at least sounding very hawkish, for the stable prices goal.
Exactly. And this mix slowing growth, rising inflation pressures, that's the stagflation light scenario. It presents the toughest trade-offs for monetary policy. You're caught between that rock and a hard place.
Trying to juggle two conflicting goals.
Precisely. And because of all this ambiguity, the annual Jackson Hole Symposium is just massive this year. It's the critical market event next week. Investors are going to be hanging on every word from Fed officials, looking for any hint about how they're interpreting this mess.
And Powell's speech on Friday is the main event.
Absolutely.
Yeah.
Fed Chair Jerome Powell, Friday, August 22nd. The stakes are incredibly high. His tone could either validate the market's dovish dreams and keep the rally going, or it could force a really sharp, painful repricing of those rate cut hopes. Could trigger significant volatility.
Make or break time.
Totally. We can game out a few potential scenarios for Powell's speech, and each one means something different for your portfolio. First, a dovish pivot. Powell could downplay the PPI, emphasize the slowing economy risks. That would likely ignite a broad rally. Growth stocks, risk assets would probably soar.
Okay, scenario 1. Market loves it.
Scenario 2. A hawkish stance. Powell could stress the inflation risks, especially those rising expectations, emphasize sticking to restrictive policy. That could trigger a sharp correction in stocks, spike in bond yields. Market hates it.
Right. Painful.
And scenario 3, a balanced message. Powell acknowledges both risks, stresses data dependence, maintains flexibility, maybe talks about a prudent pause. This might just lead to more volatility as uncertainty continues. Investors keep guessing.
So continued confusion, basically.
Could be. That uncertainty itself could weigh on sentiment. So Jackson Hole, huge implications. 1.5 sector and industry deep dive, a rotational shift.
Okay. Moving away from the big indices for a moment.
Yeah.
You mentioned that rotational dynamic under the surface. It really felt like the market was swapping out players mid-game last week.
Yeah, it was quite noticeable.
We saw that clear, defensive, value-oriented shift. Healthcare just shot out as the leader. But then information technology, the market leader all year, actually stumbled. Tells you something about where investors are putting their money or pulling it from.
It really does. Sector performance is a great window into investor anxieties and where they're repositioning. Healthcare's huge outperformance clearly shows a flight towards stability, towards non-cyclical areas. What's interesting, though, is that other defensive sectors like utilities and consumer staples actually lagged the market.
Yeah, that seems counterintuitive. Why would that be?
Well, it could be that even while seeking safety, investors are worried about how rising costs like energy, raw materials hinted at by the PPI might hit the bottom lines of even these traditionally stable companies.
Okay, so safety, but with an eye on costs.
Possibly. And that negative return for tech has a really significant development, given how much it's driven the market in 2025. Suggests maybe a crack in that foundation.
Let's get the numbers. How did the sectors stack up?
Okay, for the week. Healthcare was the clear winner, up a massive 4.89%. Then communication services up 2.58%, consumer discretionary gained 2.42%, materials up 2.04%, financials up 1.49%, energy up 0.92%, and real estate gained a modest 0.39%.
So a mix there. And the laggards.
On the downside, industrials were down just slightly, 0.09%, information technology down 1.18%, consumer staples down 0.48%, and utilities were the worst performer, down 0.54%.
Quite a spread. Definitely shows the market picking winners and losers more carefully.
Yeah, increasingly discerning, moving away from just blindly buying the past winners.
Okay, let's zoom in on healthcare. That huge 4.89% gain. You said it wasn't across the board.
Not at all. It was almost entirely driven by one single stock story. The news that Warren Buffett's Berkshire Hathaway had taken a big new stake, about $1.5 billion, in United Health Group, UNH.
The Buffett effect again.
Classic Buffett bounce. When he makes a move like that, especially in a stock that had been underperforming, it sends this wave of confidence. It had a huge ripple effect across the whole managed care industry. Shares of competitors like Centene, Molina, Elevance Health all got a big lift too.
Amazing how one investor's move can sway a whole sector like that.
It really is. Shows the weight his name still carries, even if the underlying sector fundamentals didn't change dramatically overnight.
Okay, now the other side of the coin. The semiconductor stumble. You said Infotech's negative week was crucial.
Absolutely crucial. Because tech, and specifically semis, have carried so much of the market's gains this year. The pressure really focused on the semiconductor industry and hit late in the week, wiping out earlier gains.
And the trigger was Applied Materials, AMAT.
Yep. AMAT is a key supplier of the equipment used to make chips. They came out with a disappointing forward-looking outlook. On Friday, their stock plunged about 14%.
Why the disappointment?
They cited slowing demand and significantly pointed to specific worries about their business in China. That hit a nerve.
And it spread.
Immediately.
Yeah.
Had a negative impact across the whole semi-complex. Peers like KLA Corp, Lam Research fell sharply too. The main semiconductor index, the SOX, dropped over 2% on Friday. Even giants like NVIDIA and Broadcom ended down.
Okay, so it's more than just one company having a bad outlook.
I think so. This weakness in semis, it could be a leading indicator. Maybe the first real crack we're seeing in that seemingly unstoppable AI-driven spending cycle that's fueled so much of the 2025 market rally.
How so? Explain that link.
Well, demand for advanced chips is basically a direct proxy for how much companies are investing in AI infrastructure. So when a key supplier like AMAT gives weak guidance and specifically mentions China linking it to geopolitical trade risks like tariffs or tech restrictions, it directly challenges that whole narrative that the AI boom is somehow immune to macro forces.
Okay, so the AI story isn't untouchable.
Maybe not. This suggests the foundation of that tech-led rally might be less solid than people thought. It raises a really crucial question for you as an investor. Is this AI growth sustainable? Is the boom more vulnerable than we assumed? 1.6 notable movers. catalysts and consequences.
Okay, let's zoom in even further. Individual stocks, driven by earnings, strategy news, just shifting sentiment. Who were the big movers and shakers last week?
Right, some really dramatic
Among
moves.
the top performers,
Yeah.
obviously United Health Group, UNH, biggest gainer in the Dow and S&P, soared over 12% just on Friday, finished the week up an incredible 21.2%.
Just massive.
And like we said, solely driven by that Berkshire Hathaway filing, a $1.5 billion stake revealed. Powerful vote of confidence in a stock that was actually lagging year to date, the Buffett effect in action.
Absolutely textbook example.
Then you had Intel, INTC,
Mm-hmm.
rallied an impressive 23.11% for the week.
Big week for Intel.
Yeah, driven partly by that early week strength in semis before the AMAT news, but also more specifically by speculation about potential U.S. government support. You know, subsidies or tax breaks for domestic chip production to counter tariff impacts. That gave Intel a real boost.
Interesting. Government policy playing a role there.
Definitely. And then we saw some of those more speculative high beta stocks just explode higher, probably fueled by that risk-on mood early in the week.
Yeah, some wild moves.
Tilray, TLRY, surged 58.78%. Hanesbrands, HBI, jumped 32.85%, and Paramount Skydance, PSKY, rose 30.54%. Paramount also got a lift from positive buzz around that huge $7.7 billion deal for UFC broadcasting rights.
Yeah.
Big strategic move.
Wow, some huge percentage gains there.
Now, flipping to the key laggards, stocks that really highlighted those emerging headwinds.
Right, the other side of the story.
Applied Materials,
Yeah.
as we covered. One of the S&P's worst performers, plunging 12.5% to 14% on Friday after that guidance miss, sent ripples through the whole semi-space. Its decline is kind of a warning sign.
Definitely a bellwether.
Monday.com, MNDY, the software firm, actually the week's worst performer among stocks Morningstar tracks, fell a huge 29.15%.
Ouch. That's steep. Likely earnings related.
Almost certainly tied to a specific earnings report or guidance that really missed the mark. Signals maybe some operational issues, tough competition in project management software, or maybe just a slowdown in companies buying software.
Yeah, something specific went wrong there.
And lastly, Celanese, CE, the specialty chemicals company, dropped 11.59%. As a cyclical, it's really sensitive to global industrial demand and input costs. Its sharp drop kind of reinforces those worries about manufacturing health and rising producer costs that the hot PPI flagged.
Right. When basic material suppliers like Celanese struggle, it suggests broader industrial slowing and maybe higher costs are starting to bite into margins across the board.
1.7.
Cross-asset analysis, a correlated response to the uncertainty.
Okay, so it wasn't just stocks reacting to all this push and pull. Other asset classes, bonds, commodities, currencies, they were all reflecting that same uncertainty, those same shifting stories. It's all connected, right? Looking at these other markets gives us a fuller picture.
Absolutely. So how did these different areas reflect those core tensions we've been talking about? Let's start with U.S. Treasuries. The Treasury market, usually seen as the ultimate safe haven, had some serious whipsaw action last week. Investors were reacting directly to that conflicting inflation data.
So yields were jumping around.
Big time. Remember, yields move inversely to prices. So yields initially fell across the board after Tuesday's soft CPI as rate cut odds shot up. That was the bond market bidding heavily on a dovish Fed.
Okay, lower yields.
But then a sharp reversal after Thursday's hot PPI and Friday's strong retail sales. Yield shot back up again. The key 10-year Treasury yield ended the week around 4.32%, up about 4 basis points from the prior week.
And the two-year yield, that's more policy sensitive, right?
Right. The 2-year finished the week at 3.75%. Now here's an interesting point. The spread between the 10-year and 2-year yields stayed positive, around 57 basis points.
What does that tell us? Isn't an inverted curve the recession signal?
Usually, yes. An inverted curve, short-term yields higher than long-term, often precedes recessions. But here, the curve remained positively sloped, or steep. Typically, that signals the bond market does not expect an imminent recession. Suggests some underlying optimism about longer-term growth, despite all the short-term noise. It's a subtle but important counterpoint.
Interesting nuance there. Okay, what about commodities?
We saw a split there, driven by different forces. Crude oil, WTI prices fell sharply, down over 5% for the week, closing near $63.44 a barrel.
Why the drop?
Mostly concerns about global growth. Worries that new tariffs, ongoing trade disputes could slow down global trade and manufacturing, which would mean less demand for energy down the road. Oil prices often track global growth fears.
Makes sense. But gold went the other way.
Exactly. Gold acted like a classic safe haven. Rose 1.14% for the week, closing around $3,452 an ounce. It clearly benefited from all the economic uncertainty, the conflicting data, the risk-off mood later in the week, and there was also some speculation late in the week that might have helped. Reports that Washington was thinking about putting country-specific import tariffs on gold bullion bars.
Tariffs on gold. How would that work?
It would restrict supply, essentially, making existing gold potentially more valuable, thus pushing prices up. Added another layer to the gold story.
Fascinating. And finally, the U.S. dollar.
The dollar index, the DXY, which measures the greenback against other major currencies, it fluctuated quite a bit, reflecting those shifting Fed bets. It ended the week down slightly, about 0.45%, closing near 98.26.
So weakened by rate cut hopes initially.
Yeah. Lower expected interest rates tend to weaken a currency because it makes holding assets in that currency less attractive. But then the dollar found some support later in the week as Treasury yields rose again, making dollar assets look a bit better relative to others.
So the dollar was also caught in that push and pull.
Exactly. Reflects all the underlying uncertainty about what the Fed does next, how they balance inflation versus growth.
The week ahead, August 18-22, 2025.
Okay, let's shift gears and look ahead. The upcoming week feels absolutely pivotal, doesn't it? Market direction seems almost entirely dependent on what comes out of the Fed's Jackson Hole meeting.
Yeah, all eyes on Wyoming.
But beyond that main event, there's still a packed calendar. Key economic data, some important corporate earnings, especially from retail and tech bellwethers. That'll add another crucial layer of information. Feels like this is the week where the rubber really meets the road.
Agreed.
Yeah.
So what exactly should you be watching for? The main event, no question, is the Jackson Hole Economic Policy Symposium. Runs Wednesday, August 20th through Friday, August 22nd. This annual powwow of central bankers, economists from all over the world is going to dominate market activity, dominate sentiment.
Any specific speakers to watch besides Powell?
Well, Fed Governor Christopher Waller speaks on Wednesday. His views are always closely watched. But really, the absolute focal point is Chair Jerome Powell's speech on Friday. The market is desperate for a clear signal about September's FOMC meeting, the tone he strikes. It could either validate this recent rally and the rate cut hopes, or it could trigger that sharp, painful correction we talked about.
High stakes.
Extremely high stakes. Every word, every nuance will be dissected.
Okay, so Jackson Hole's number one. What about the economic data coming out?
Still some important reports hitting the wires, giving fresh data points for the Fed and for investors. Monday, August 18th, we get the NAHB Housing Market Index, that's homebuilder sentiment. Tuesday, August 19th, building permits and housing starts for July. Key reads on future construction. Thursday, August 21st, usual weekly jobless claims, plus the Philadelphia Fed Manufacturing Survey for a regional snapshot, and existing home sales for July. And then Friday, August 22nd, we get the S&P Global Manufacturing and Services PMI flash readings for August.
Those PMI numbers on Friday sound important, coming out right before Powell speaks.
They are potentially very important because they offer the first real-time glimpse of economic activity in August. A weak number, especially in manufacturing, might bolster the case for a rate cut, give the Fed cover. But a strong reading, particularly if the services prices paid component comes in hot, that's a key inflation measure, would just further complicate the Fed's decision right as Powell is about to take the stage. Could really intensify that policy dilemma.
Wow, talk about timing. Okay, what about corporate earnings? Peak season is over, but still some big names reporting.
Yeah, the main rush is done, but this week features several really important bellwethers. They'll offer critical insights into consumer health and how much businesses are spending. Real windows into the economy. Let's see. Monday, August 18th, Palo Alto Networks, BHP Group, Foot Locker. Tuesday, August 19th, Home Depot, Toll Brothers, important reads on housing and home improvement. Wednesday, August 20th, big day, Salesforce, Lowe's, TJX Companies, Target, Analog Devices, Synopsys, and Thursday, August 21st, another big one, Walmart, Intuit, Ross Stores, Workday, Zoom.
Okay, lots of retail in there. Walmart, Target, Home Depot, Lowe's. That should give a really good checkup on the consumer, right?
Absolutely. A comprehensive, timely checkup.
Huh.
Are they still spending? What are they buying? Discretionary stuff or just necessities? Are they trading down? We'll get crucial insights into the health and confidence of the U.S. consumer.
Now, on the tech side, anything crucial besides Salesforce?
NVIDIA. NVIDIA's report, expected Wednesday or Thursday, is absolutely paramount. Not just for the company, but for that whole AI narrative we discussed.
Ah, right. Testing that AI strength again.
Exactly. Any sign of weakness in their data center segment, the part that powers AI, could have severe market-wide ripple effects. Could really amplify the concerns raised by Applied Materials last week. Could be that second crack in the AI growth story, forcing a major reassessment of the tech sector's outlook.
Okay, NVIDIA is definitely one to watch then. Anything else on the radar for next week? Minor stuff.
Just briefly, a couple of other things. Several ex-dividend dates are coming up Monday, August 18th for companies like Apollo Global Management, Constellation Energy, TPG Inc., mainly relevant for income investors tracking payouts.
Right. Need to own the stock before that date to get the dividend.
Correct. And there are a few minor stock splits, notably a 1-for-80 reverse split for Chanson International Holding on Monday.
Reverse split. That's usually not a great sign, is it?
Typically not. Regular splits can signal growth, but reverse splits often mean a company is struggling to keep its share price up. Reduces the share count to artificially boost the per-share price. Can be seen negatively. But these events usually don't move the broad market much, just things for specific investors to note. Outro.
So wrapping this all up, what does it mean for you trying to navigate this really complex market? Last week was just a fascinating picture of that internal tug of war, wasn't it? New highs, but hiding this underlying fragility, all fueled by rate cut hopes that are now facing a serious challenge from sticky inflation. Shows how fast the story can change with new data. How important it is to look deeper than just the headline numbers.
It really does. And from that broader view, it just underscores how vital critical thinking is when you're overloaded with information. You're seeing right here how these conflicting data points create genuine policy dilemmas, create market volatility. That Jackson Hole meeting. It's not just economists chatting. It's the Fed trying to make sense of this exact puzzle.
Yeah.
And how they interpret it will profoundly shape market expectations for months. Your ability to understand these connections, these nuances, that's going to be key.
So let's leave you with a provocative thought to chew on as you digest all this from our deep dive. As the market seems determined to cling to these hopes of a soft landing, of quick rate cuts, how much can it really take? Before the reality of persistent inflation, maybe renewed supply chain issues, that shaky consumer sentiment forces a more significant repricing.
Yeah.
What's really holding up the market's strength if its former leaders in tech are wobbling? And is that old buy the dip playbook still sustainable when the signals are this contradictory? We hope this deep dive has given you a clearer lens, maybe some better tools, to view these questions and make sense of this incredibly dynamic market we're in right now.